Well, the federal government's plan to bring the budget back to surplus became even tougher today, with the iron ore price slumping to a 5-year low. Critics blame resource companies for flooding the iron ore market with supplies just as China's economy slows. But the big miners are unrepentant and are sticking to their expansion plans. Neil Woolridge reports.
The mining boom helped Australia dodge the worst of the global financial crisis, but those glory days are a distant memory, and now the plunging iron ore price is creating headaches for the government.
The further the iron ore price falls, the harder it is for the government to get back to budget surplus because, of course, it's limiting income growth. It puts downward pressure on tax revenues.
The iron ore price has halved over the past year, falling another 3% overnight to a 5-year low of $70 a tonne. A global oversupply is the main culprit, combined with weaker demand from China. But the world's biggest miners are pressing on with plans to add another 100 million tonnes to output, or 6% this year and next. And despite the fall in iron ore prices, BHP Billiton expects to maintain its dividend.
Looking after the dividend is the number one imperative for the board and for, I think, the management team that I have the privilege to lead. And as things sit, we feel that the dividend at its current level is well covered.
Notwithstanding the resource giant's optimism, many analysts are tipping the iron ore price will stay below $80 a tonne in the year ahead.
You've still got that, flattish demand outlook from China property, and the supply side is still going to grow again next year. So, the price outlook looks pretty bad for next year.
And much will depend on whether high-cost Chinese iron ore miners scale back or close down production.
It seems likely that at some point in time you will see a fall in Chinese production of iron ore, although there are limited signs of that happening as yet.
There's other factors at play behind just, profitability. So, many of the private guys are cutting costs, and as I mentioned, local governments are reducing the tax impost on these miners, which can be, substantial, $20, $30 a tonne in some cases.
Now, Australian resources companies face another challenge, with China capping the growth rate of its coal use to 5% a year, less than half its average growth of the past decade. The slump in commodity prices has helped push Australia's terms of trade, the ratio of export prices to import prices, down more than 10% this financial year. Based on Treasury sensitivity analysis, that would add an extra $2 billion to the budget deficit this financial year and $4 billion in 2016.
We will continue to focus on repairing the budget, and we are quite hopeful that over time people will accept that we're making the right judgments for the right reasons.
They need to do one of two things. They need to find more revenue from somewhere, and that involves some tax reform, which needs to be on the agenda in our view, or find additional spending cuts.
Either way, more unpalatable decisions loom for a government that's already well behind in the polls.